Let me be direct with you. I've been doing this for over 30 years. I've sat across the table from CEOs, hedge fund managers, sovereign wealth funds, and retail investors who thought they had it all figured out. And I can tell you right now, the investors who lose the most money are never the ones who made bad decisions. They're the ones who made no decision at all. They froze. They waited. They hoped. And hope, I promise you, is not an investment strategy. Right now, as Middle East tensions continue to escalate, I'm watching a very specific set of stocks sitting in people's portfolios like time bombs. And most investors, whether they're holding $100,000 or $10 million, have no idea what's about to happen to them if this geopolitical situation deteriorates further. So today, I'm going to tell you exactly what I'm doing with my own money, not what some analyst on a panel says. What I personally am repositioning right now. But first, I want to ask you something directly. How much of your portfolio is exposed to energy, travel, or emerging market equities right now? Drop your answer in the comments below, because I want to understand where you are, and I want to tell you whether you should be concerned. This conversation matters, and I think it's one most financial media is afraid to have clearly. Now let's get into it. Every experienced investor knows that geopolitical risk is the most underpriced risk in modern markets. People obsess over interest rates. They obsess over inflation data, Fed minutes, earnings per share, price-to-earnings ratios. All of that matters. But geopolitical shocks, they're the ones that hit you sideways. They move fast, they move hard, and by the time the average retail investor reads a headline, the institutional money has already moved. That's the first thing you need to understand. The market doesn't wait for clarity. It prices in fear before the facts arrive. And right now, the Middle East situation has introduced a level of uncertainty that I haven't seen priced into certain sectors with the seriousness it deserves. Let's talk about energy first, because this is where it gets complicated, and most people get it completely wrong. The instinct when you hear Middle East conflict is to rush into oil stocks, buy energy, buy crude exposure, buy the drillers. And yes, Brent crude has moved, WTI has responded. But here's what the unsophisticated investor misses entirely. There's a massive difference between a short-term oil price spike and sustained, profitable upward movement for energy equities. The two are not the same thing, not even close. When tension escalates in that region, you do get a fear premium built into oil prices. But you also get something else simultaneously: supply chain uncertainty, shipping route disruptions, insurance premium explosions for tanker operators, and a global demand suppression effect if the conflict spreads and damages economic confidence across emerging markets. These things happen at the same time. They cancel each other out in ways that make energy stock performance deeply unpredictable. So if you're holding undiversified, single-name energy stocks with heavy Middle East exposure, particularly companies with significant operational assets in or near conflict zones, I would be trimming those positions right now, not panicking. Trimming. There's a difference. Panic is emotional. Trimming is surgical. Here's what I tell every entrepreneur and every investor I mentor. The best defense isn't pessimism. It's precision. Know exactly what you own, why you own it, and under what conditions the thesis breaks. If your thesis for holding a particular energy company was stable Middle Eastern operations or uninterrupted Gulf shipping lanes, and those conditions are now in question, the thesis is broken. You don't need permission to exit. You need conviction. Now let's talk about defense stocks, because here's where I want to challenge your thinking. The conventional wisdom says conflict in the Middle East, buy defense, buy Lockheed, buy Raytheon, buy Northrop. And in the short term, yes, there's momentum in those names. Government contracts get accelerated, budgets get revisited, NATO allies talk about spending increases. There's a narrative that drives price action in the sector. But here's what sophisticated money is actually asking. Are these companies going to deliver earnings that justify the premium the market is now assigning them? Because right now, some of these defense names are trading at valuations that assume a decade of elevated conflict spending baked in, and defense procurement cycles are slow, bureaucratic, painful. The contracts don't hit the income statement immediately. I'm not saying exit defense entirely. I'm saying be careful about chasing defense names after they've already run 15 or 20% on geopolitical fear. You're not getting ahead of the trade at that point. You're becoming the exit liquidity for someone smarter who got in before you. This is the psychological trap that destroys retail portfolios. They see the sector moving. They feel the fear of missing out. They buy in at the top of the fear trade. And then when clarity emerges, when tensions de-escalate or a ceasefire is announced, those same stocks give back every gain in 48 hours. I've watched this happen repeatedly, and it's preventable. Now here's a category that almost nobody is talking about, and I think it's the most dangerous exposure of all right now. International travel and hospitality equities with heavy Middle Eastern and European corridor exposure. Think about airlines. Think about hotel chains with significant Middle Eastern property footprints. Think about cruise operators who route through regions that are now operationally uncertain. These businesses are extraordinarily sensitive to geopolitical instability. They don't just lose bookings when conflict happens, they lose forward bookings. Travelers cancel trips 6, 8, 12 months out. Corporate travel freezes, and the revenue doesn't come back quickly. The recovery curve in travel is not a V-shape, it's a slow crawl. If you're holding airlines or hospitality names that are heavily exposed to affected corridors, I'd be looking very carefully at your position sizing. Not eliminating necessarily, but asking honestly, do I understand the downside scenario here if this conflict extends another 6 months, another 12, because the range of outcomes matters? And the worst case scenario for travel equities in a prolonged regional conflict is significantly worse than most investors currently have modeled. Let me talk about something deeper here, because this is ultimately not just about which stocks to sell, it's about how you think. The average investor treats their portfolio like a fan treats a sports team. They develop emotional loyalty to positions. They root for their stocks. They interpret bad news as temporary and good news as confirmation of their genius. That's not investing. That's gambling with extra steps. The wealthy investor, and I mean genuinely wealthy, the kind of wealth that persists across generations in economic cycles, treats every position as a contract with the market. You own a stock because you have a thesis. That thesis has conditions. When the conditions change, the contract changes. There's no sentimentality in it. There's no loyalty. There's only clear-eyed analysis and disciplined execution. Middle East tensions changing, that's not a reason to panic. It's a reason to audit. Go through every single position you hold and ask, which of my assumptions about this company's operating environment have just changed? Which revenue streams depend on stability that is now uncertain? Which supply chains run through geography that is now compromised? Answer those questions honestly, and you'll know exactly what to hold and what to cut. Now I want to talk about where I am actually putting capital in this environment, because I don't just tell people what to avoid, I tell them what I'm doing. Domestically oriented businesses are getting more attractive to me right now. Companies that generate the majority of their revenue inside the United States with domestic supply chains, domestic customer bases, and limited geopolitical exposure. These are businesses that essentially have a natural hedge against international instability. When the world gets uncertain, capital flows toward clarity. And right now, clarity lives in domestic cash flow businesses. I'm also looking more carefully at sectors that benefit from sustained higher energy prices without having direct operational exposure to conflict zones. Think about energy infrastructure inside North America. Pipelines, storage, processing. These businesses move energy regardless of where global prices go, and they generate consistent fee-based revenue that doesn't require accurate macro predictions to deliver returns. That's what I want in an uncertain environment. I'm also increasing my attention on companies with significant pricing power and low capital intensity. Businesses that can raise prices in an inflationary, uncertain environment without needing to spend heavily to maintain their competitive position. When geopolitical instability compresses global economic activity, those businesses maintain their margins while levered. Capital-intensive competitors suffer disproportionately. Now let me address the macro picture directly, because I know what some of you are thinking. You're thinking, Kevin, this has been going on for decades. The Middle East has always been volatile. Markets have always recovered. Why is this time worth repositioning? Here's why I take this moment seriously. The interdependencies have changed. The global economy in 2025 is more fragile in specific ways than it was 10 or 15 years ago. Interest rates are elevated relative to the post-2008 era. Corporate debt levels are significant. Consumer credit stress is real. We don't have the monetary policy cushion that existed in previous geopolitical shock events. The Fed doesn't have the room to respond to a shock the way it responded to COVID or to 2008. That changes the risk calculus fundamentally. When you have elevated geopolitical uncertainty combined with limited central bank flexibility combined with already stressed credit markets, the downside scenarios get wider. The tail risks get heavier. And that's exactly when portfolio construction matters most. That's when the difference between a resilient portfolio and a fragile one becomes apparent. Not when everything is going up, when stress arrives. I built my first real wealth, not by picking the best stocks during good times. I built it by surviving bad times better than my competition. That's the actual game. Outperformance in chaos, preservation when others are panicking, and positioning yourself so that when the recovery comes, because it always comes, you have capital to deploy at the bottom rather than losses to recover from. The investors who come out of every geopolitical shock event with more wealth than they entered with are not lucky. They are prepared, they thought ahead, they trimmed when it was uncomfortable. They held cash when everyone told them cash was trash. And when blood was in the streets, they had the capital and the psychological clarity to act. That's what separates the people who talk about money from the people who actually accumulate it across decades. So here's my challenge to you right now. Open your brokerage account today, not tomorrow, today. Look at every position you hold and ask 3 questions. 1, what is my thesis for holding this? 2, has anything about the current geopolitical environment challenged that thesis? 3, if this position declined 30% from here due to conflict escalation, would I add more or would I regret owning it? If you can answer those 3 questions honestly, you will know exactly what you need to do, and you won't need me or anyone else to tell you. That's the goal. That's financial literacy. Not following someone else's moves, but building the analytical framework to make your own decisions with confidence. The markets are not a place where hope pays dividends. They're a place where preparation gets rewarded. Tension is rising, uncertainty is real, and the investors who act with precision right now will be the ones looking back in 12 months saying they made the right call, while everyone else is explaining why they held on too long. I've made my moves. The question is, what are you going to do with yours? Drop your current portfolio exposure in the comments below. What sectors are you holding right now, and are you concerned? Let's have the real conversation.